the Financial Survival Network. Now more than ever.
And welcome. You are listening to Watching the Financial Survival Network. I'm Kerry Lutz. Well, these markets are the punch bowl has been pulled away, and the participants haven't realized it yet. They're just starting to. The question is, when will they put the punch bowl back? This person has been calling this thing almost as if he has the Fed's playbook on his desk. I'm talking about Michael Pento, Pento Port. Michael, it's great to have you on as always. So what is next in the Fed's arsenal?
Mr. Lutz, great to be on with you. Well, as usual, I just listen to everything that comes out of Mr. Powell's mouth because the Fed is always correct. They've got such this keen, erudite insight on everything, like when they told us inflation was transitory. I mean, that was spot on, right? And now Mr. Powell is telling us investors that we have no recession in sight. In fact, a soft landing is, it's maybe not exactly the base case, but it's highly likely, or at least possible. Maybe it'll happen, maybe it won't. What is he talking about, Kerry? We have it's amazing to me how, the emperor has no clothes, and then what's the guy in The Wizard of Oz, the guy behind the curtain,
The wizard.
The wizard over there, thank you. I mean, they're telling you that there's no recession likely until maybe 2024, but we're in one now. It's not my opinion. I mean, what is a recession? Like my dentist says, I have recession in my gum. It's a pulling back, it's a contraction. Well, the way they define a recession is 2 consecutive quarters of negative GDP growth. Well, Q1 was minus 1.6, and the Atlanta Fed has us contracting about the same rate. It was negative 2.1 before we got the bogus employment report from the Labor Department on last Friday, and we'll touch on that too, I'm sure. Remind me if I don't get to it.
Sure.
Either way you slice it, we have 2 back-to-back negative quarters of GDP growth. We are in a recession. So I don't know what the big deal is. Why can't we just admit it and say, yes, the economy is contracting, and we have a Federal Reserve that cannot come to the rescue like they usually would in this instance. Believe me, if inflation was still at 1.7%, remember, Kerry, let's just reminisce back to the good old days, the halcyon days of 2018, 19.
I like that word.
When the Fed was just telling us, an economy just can't function unless inflation is 2%. If it's 1.7, it's the end of all incarnation. It's an existential threat to you as an American and to the US economy. 1.8, still not quite. Let's get it to 2 at a minimum. Well, we got to 2, and then we got to 20 very quickly. It's not 8.6. I understand it's 8.6 officially. I get that, all right? But it's 20 if you look at housing, energy, food. The year-over-year rate of inflation is 20%. So they got to 2, and then it skyrockets it to 20. So the Fed has no idea what they're doing, and they're forced to hike into a recession because they have no choice, because home ownership is unaffordable, and the economy is not functioning for anybody who isn't in the ultra top end, the top quintile of the economic strata.
Mm-hmm. And that's the good news. Well, the old saying, Michael, recession's when you're out of work, a depression's when I'm out of work, or like the definition of minor surgery, that's surgery that someone else has. If I got it, it's major, even if I'm getting a hangnail removed. But so they can't cut because they're in a trap, because then the dollar will just get decimated, right? And they just keep raising, and then the dollar keeps going higher, which is killing manufacturing and exports because it's up, it's way up. And but it's good to know that we're not in a recession, even though by the traditional definition of a recession, we're in one, and arguably the GDP deflator has been distorted. We could have easily been in one for 3 to 4 quarters, and nobody seems to be looking at that either, right?
I mean, the trim, mean, hedonically adjusted inflation indicator from the personal consumption expenditure index, price index. You mean that's not really an accurate measurement of inflation? Is that what you're telling me? No, I gotta say that, if inflation is running at 20% in reality and 8.6% the way the BLS, Bureau of Labor Statistics, calculated, which is a division of the Labor Department, 8.6%. It's that high, really a record high, even going back to 1980. We're at a record high rate of inflation with the US dollar surging by 15% year over year. I would like to imagine, see, this is my conundrum here. It's not really mine, it's the Fed, it's Mr. Powell, who should have taken that victory lap. He should have said, you know what, last year, I don't need to run again. I was successful getting us out of the great pandemic, and I'm retiring with my hundreds of millions of dollars.
Go out on top.
With his hubris and arrogance, he wanted to stay on. But here's the conundrum for Mr. Powell now. If he assents to the supplicant Wall Street and says, I want to cut rates now to save the U.S. from the recession and the stock market, which is down, and it's a bear market in every index that you measure, every major index that counts. What's going to happen to the U.S. dollar at that point? Well, as I said, it's up 15% year over year, and we have record high inflation. The U.S. dollar is going to tank. And if you tell the world at that point, when inflation was 8.6% in May, year over year, inflation was 8.6%. So we no longer have this, oh, we can't get inflation. Oh, we have productivity. We're importing deflation. All that bull, that is over. We know how to create inflation now. You pay people to stay at home and not work. They've done that already. They've done it. It's called helicopter money. It worked spectacularly. I could have told them that, hey, you want inflation? Give people a check monetized by the Federal Reserve, create new money, bring the base money supply from 800 billion to 9 trillion, and tell people not to go outside because they're going to die if they take a breath of air. Well, then you get inflation. So if we go now, if the Fed tries to save the economy and the stock market now, when inflation just was 8.6%, you've inculcated now very clearly how to get inflation through exactly what they need to do to get it higher, to stop the stock market from falling and from the economy from sinking. Your inflation is going to run intractable. So, and here's the other side of that. If they actually fight inflation like they just started doing, I mean, we now have the effective Fed funds rate is 1.6%. Inflation is at 8.6. Effective Fed funds rate is 1.6. Okay, that's 700 basis points of rate hikes that they need to do, but maybe they don't have to go so far. Let's just say, Kerry, the Fed believes that neutral is 3 to 3.5. That's what they say. Mm-hmm. Well, they're still miles away from 3.5% just to get to neutral. Yeah. They have to go to restrictive. And the balance sheet has to start really the balance sheet is only contracted by 74 billion. So not that much. We're still at $8.9 trillion on the balance sheet. So they're just starting to they're just now starting to fight inflation, but we're already in a recession and we already have a bear market. So I wouldn't want to be Mr. Powell. No way.
Isn't that the definition, Michael, of stagflation, what we got here?
Right now you have stagflation. I think on the second derivative basis, you'll be in disinflation in the next few months. The only question I have after that is, will it become outright deflation and depression? Because that's a very real risk. The credit markets are signaling to me. I don't listen to Brian Belsky and the rest of the show on CNBC. It's just unwatchable what comes out of their mouth. One guy Leibniz is talking about factories are popping up all over the place. I mean, let's look at reality. What is the market trading on? It's trading on the fact that the Fed is forced to aggressively, perhaps the most aggressive tightening cycle ever, into a recession. And they have to do it. They really have no choice. And when they break something, and things are breaking as we speak, and I'm looking at the credit markets most assiduously, the money markets, the credit markets, commercial paper, CCC junk bonds, even investment grade. I'm looking at the the banking system, the shadow banking system, they're under a lot of pressure. Collateralized loan obligations, the real estate market, mortgage-backed securities, they're going to break something by the end of this year. And then you fall into a deflationary depression, and then you say, oh, it's all about duration, Kerry. Then the Fed has to come in. They have no choice but to save the stock market and the economy. They have to reliquefy the money markets.
That's the pivot, right?
And that's the Powell pivot. Now, I have to remind you, and I'm not you, at least your audience has to be aware, that it normally takes hundreds of basis points of rate reductions and some combination of QE to get the stock market and the economy right again. Correct. So when people say that Powell's going to pivot, does that pivot mean that he stops raising interest rates but continues with QT? That's not really a pivot. So I'll remind your audience that in 2000 we had to drop the Fed funds rate by 600 basis points, and that didn't stop the Nasdaq from losing 83% of its value and the S&P from losing 50. In 2008, we took interest rates to zero from 5.25. So 525 basis points of rate cuts and QE to turn around the situation. But the S&P still fell by 50% before it turned around. In 2020, the Fed was already cutting from 2.25, remind you, 2.25 to 1.75. Then they went back to zero and printed $4 trillion. But the stock market still dropped by 33%. So when people tell me, well, the Fed has got your back and they're going to assent to the notion that, hey, something's broken and I'll stop hiking rates, they might stop at 3.5. Kerry. Is stopping at 3.5 enough to save the stock market, the economy, and to put us back on an inflationary track? I don't know. It's probably going to take, the answer is probably no. It's probably going to take a massive reliquefaction of the money markets. I'm talking about a combination, an unholy combination between Powell and Janet Yellen, head of Treasury, to once again monetize multiple trillions of dollars in debt to get the economy back, on its footing. And that is going to be intractable stagflation, not a normal economy. It's not going to be a normal rebound because, again, remember, we just finished 8.6% inflation. If you tell us that you're going to go back to the playbook of 2020, of January, February of 2020, it's game over. Inflation will never come down for a very, very, very long time. It'll run intractable.
So that is an impossible choice for the Fed. And they can't do something in the middle because it's going to be ineffective. And will they just bite the bullet and say, all right, we'll just have inflation for a generation like everyone else in the world? And what's that going to do to all the other countries in the world, as well as China, which seem to be collapsing as quick as the United States, or perhaps even quicker?
I read Bloomberg is probably the best of the, I call it the amoeba with the highest IQ as far as the mainstream financial media. Bloomberg actually did a story that June had the highest credit impulse from China in the history of that red nation. And I'm thinking to myself, wait a second, didn't we just have a collapse of Evergrande, not too long ago? I mean, this country was collapsing because people could no longer afford the real estate market. They couldn't build any more bridges to nowhere. They had a massive fixed asset bubble that the government of China was finally addressing. And now they're borrowing and printing like never before. It's just mind-boggling what's going on.
And the yuan is sinking against the U.S. dollar to levels really never seen before. And
it's not even a free-floating currency. Imagine if it was actually a tradable currency.
Can't imagine. So it's bad all the way around. There's no bright spots in the world, are there?
There has never been a time in 80 central banks around the world are tightening monetary policy. 80 into a global recession. This is the worst And I said this, by the way, in July of 2021. I said 2022 will be one of the worst bear markets we have ever seen. And that is exactly what's happening, and it's not even over yet. I don't think fair value could even be begun to be assessed on this market until the S&P is closer to 3,000.
So,
and it's trading at 3,900.
You're talking a deflationary collapse of the economy, which means you need to have cash. Debt doesn't matter because nobody's going to be paying debts in this economy that you're envisioning. Cash is king.
Well, I will say this, that there's only 4 things that work in the environment that I just mentioned, because the R squareds, the correlations all go to -1. Or everything trades together, except for shorts. Shorts actually work, the US dollar, and treasuries. Those are the only things that work. And treasuries haven't been working that well because they were in a massive bubble. So this is one of the few times when in fact, since 1980, this was a very easy game to play. You understand this.
Sure.
Since 1980, it was a very easy game to be successful on Wall Street. You just bought bonds and bought stocks, and bond prices went up as the yields fell, and stocks were in a skyrocket ship because since 1980 we had nothing but disinflation and a lack of inflation. The way the Fed and the BLS and the government measures inflation.
Sure.
We don't have that problem anymore. You have record high inflation and you have falling asset values. We haven't even begun to scratch the surface on the home price depreciation. Mortgage applications to refinance a home are down 78% year over year. I can't wait for the bank earnings to come out this week. They're supposed to be coming out this week. I think they should be a disaster. It should be a disaster. And forget about, talk about driving me crazy. You can't watch the mainstream financial media. They're talking about in nominal GDP is rising, so nominal earnings should be rising too. Well, I have 2 things to say to you. Well, what about demand destruction and margin destruction? Let's put that one aside for a second, because you can't just calculate nominal GDP and assume you have nominal earnings growth of 10%. That's ridiculous. And so you have margin destruction and demand destruction. But don't you think we should also calculate in the fact that these earnings aren't buying anything? The earnings have lost their purchasing power. Doesn't that count for anything for Wall Street? So, we have just begun to price in the worst bear market since 1929, and it might even be worse than that.
Yeah, that's pretty wild. If it's worse than 1929, it's a good thing that these skyscrapers, nobody's working in them, and the people that are, they can't open the windows, right?
Yeah. Well, on a better note than that, I'll tell you this. What is your thought about the non-farm payroll report on Friday? I think it was amusing to me that you have the ISM services index and the ISM manufacturing index. So there's 2 sectors to the economy: services and manufacturing. Both of those surveys show that employment fell last month, just declined. So where the Department of Labor, the Bureau of Labor Statistics, came up with 370,000 people is utterly amazing to me. And the willingness of Wall Street to accept that establishment survey number is complete sophistry and buffoonery. If you look a little bit deeper, there's something called the household survey. The household survey showed that 315,000 people lost their job. And the household survey always precedes and leads the establishment survey. So yes, we are in a recession. People are losing their jobs. Their home price is about to tank. Nobody's refinancing their mortgage anymore. Bad news for the banks. Year over year, purchase applications are down 17%. The economy is in a recession. 80 central banks around the world are raising interest rates, and the Fed has nothing to do but to quickly get to neutral, at least as fast as they can. There's no meeting in August, so we'll most likely have a 75 basis point rate hike on July 27th. That's what Wall Street has to deal with, along with quantitative tightening, which has just started and ramps up to $95 billion in September. And if you want to be long cyclicals, be my guest.
Anything in the stock market safe here? What about what's happening to gold? I mean, obviously there's a liquidation in progress when you see gold lose $100 when inflation is doing nothing but going up.
Well, far be it for me to remind your audience and you about my warnings about what happens to gold in a liquidity crisis. I said there would be a narrow window, maybe a few months long, where gold is sold, it's dumped for one reason. People need to raise dollars. You said it yourself. People need liquidity. They sell houses to raise money to pay back their debt if they can, which causes asset prices to tumble, which causes the dollar to surge even further. You know, a lot of there's a $10 trillion of dollar denominated debt around the world. And these emerging markets have to raise money in dollars to pay back the loans. That means they have to sell their assets overseas, a lot of assets overseas, to raise a lot more currency domestically because the value of their currency is depreciating, and they have to buy dollars to pay back.
All right.
Okay.
So everybody, there's a scramble for dollars on, even though everyone agrees that the currency is worthless. But so it's the ultimate bear trap on the dollar. It's exactly what happened in 08 and 09. Exactly. And you saw the squeeze hit gold and miners, especially because they are stocks and they have all the company specific risk plus the liquidation aspect. And so this is going to go on for a while. And then when it turns, look out.
See, that's why you're with an active manager, or you listen to shows like Kerry Lutz's financial survival network. Excuse me. So you were warning. We were warning. We said that this was going to happen. We said that gold stocks are stocks first and foremost, and they're a leveraged play on gold. Gold gets sold because people need dollars. The dollar rises, real interest rates increase, and people sell what they can. But let's not overlook the other side of that story, because you're going to get assets on a fire sale. I'm talking about gold and the miners, because when the Fed truly does have to pivot, and I think it could come as early September, October, that window closes, and you'll see gold just like it did in 2009, just like it did in 2020, after the liquidity crisis eases and the Fed reliquifies the system and the dollar tanks, especially against our trading partners, against gold in the vanguard. That means that you have to be ready to pull the trigger on gold and the miners at the right time. And that's why you have financial managers like myself and why you listen to the Financial Survival Network.
So best guess, Michael, when is that time going to be? You mentioned as early as September or October. So they're going to get frightened to death, existential threat to the global financial system. And then it'll be like the Three Gorges Dam with a flood behind it. And they open the floodgates and all the cities below the Three Gorges Dam get flooded out, but the dam doesn't collapse, right?
Well, I mean, you're going to have a reckoning in the dollar. I mean, the dollar is up, as I said, 15% year over year. Put up a long-term chart of the DXY or a long-term chart of UUP, which is the dollar index bullish, which is what I own, one of the positions I own. It has absolutely skyrocketed. You'll lose all that ground very quickly. I mean, you won't be able to get out. It'll be very difficult to even get out of the dollar when it turns. Because what's the Fed going to do? They're going to cap interest rates on the sovereign level. Treasuries, they're going to start printing money like mad, tapping the interest rate, flooding the U.S. economy with dollars, and asset prices are going to absolutely skyrocket. And in the vanguard is going to be precious metals, in my opinion.
So don't despair of real estate yet either, because exactly what we saw happen, pandemic, helicopter money. We're going to see that 10x.
Yep. Well, here's the, and that's perfect, Kerry. What's the calculate? Let the Fed tell you. Let's just play this out, which is what I do in my model every day. The Fed tells you in the fall that unfortunately, even though inflation was a few months ago at a record high, we now have to do the same thing we did in 2001 and in 2008 and 2020. We have to reliquefy the banking system. We have no choice. We have no choice because we're looking at a deflationary depression which will wipe out America. That can't be the path the Fed takes. And so they're going to reliquefy the banking system, but let the Fed then tell you we're only going to do it for a couple of months. Who's going to believe them? Who's going to believe them? You mean once you get asset prices rolling again, then when you couldn't do it ever before, you weren't able to get out of that trap where interest rates constantly made lower lows throughout the last 22 years. That's been the pattern. You're going to tell me now you're going to do it in a few months? No, we know you can't do it. You'll always have to have the Fed put supporting asset prices, including the money markets, the capital markets, real estate market, junk bond market, CLOs, municipal bonds, everything will be under the support of the Federal Reserve. So inflation is going to run intractable, but I guess they're going to make the calculation that, hey, we'll take double-digit inflation other than people having to starve to death on the street.
God. The world has gotten so complex, Michael. In the good old days, it was like you had the gold, banks, governments, they cheated, they got caught, collapsed, but gold was always gold. And now we've got a 3-card Monte game going in 4 dimensions. And, it's 4-dimensional 3-card Monte. And it's coming home to roost.
Well, I mean, when you back the currency with the exchange value as like an NFT, I mean, there's just no value to it. Everybody knows now that your currency is only backed by the faith in the government to keep it scarce. And when you go from $800 billion on a Fed balance sheet, which is Fed credit plus physical currency, and you go from $800 billion to $9 trillion in the space of the Federal Reserve, that's just a blink of an eye. Since 1913, you went from 2008 to 2022, $9 trillion. That's an $8.3 trillion, 8.3 trillion trillion in base money supply. There's no faith in fiat paper. Hey, and that's the message you're giving the markets, and we're hearing it.
Yeah, well, we've been talking about this, you and I, for several years, but individually for decades now. Nobody listened. We both have clear consciences here, right?
I do, and thank God, I'm very privileged to have, clients that are on the lifeboat, very much unscathed this year from this collapse, and have virtually all of our principal ready to go whenever they truly do pivot and save the economy. And
they will.
And they will. They have no choice. Kerry, they have no choice, because I said the calculation between deflationary depression and intractable inflation, they both stink. You can't have either one. But if you had to put a gun to Powell's head, not literally, figuratively, if he had to make a choice, he'll choose inflation any day of the week. I mean, your Social Security check wouldn't cash. The bank machines wouldn't work. There wouldn't be a solvent pension fund on the planet. I mean, come on. That's not a tenable position.
And let's not forget, one thing I haven't heard mentioned lately, but I know you know it. I know every person who understands monetary theory is that the banks are the big winners on inflation because they get the money before the inflationary value of it has been assessed by the rest of the economy. So they get dollars that are worth more, get to disperse them, and they get more for their money. And that is like the biggest scam ever.
Well, another thing that went, so I got to tell you, so I went had to buy a house. It wasn't really something I wanted to do. I bought a house. The mortgage rates are through the roof. But I have a lot of deposits at a bank too. They haven't raised, and I have a lot of money at the bank. They haven't raised my interest rate on my deposit 1 basis point.
Well, there's a shock.
0.05% on completely liquid money at the bank.
Wow. Well, why am I not surprised? But their mortgage rates.
How do they get away with that? How do they get away with that?
Auto loan rates have gone up, all of that. Hey,
Credit
the
card.
spread, and that's what they always said when the banks start lending again. That's when the inflation takes off because of credit creation and all that accompanies that. Well, Michael, I think people need to give you a call, need to connect with you. Pentoport.com. Get Michael's latest assessment of the economy thus far. We've been talking for years. You've been spot on, Michael. If you got a question for Michael, shoot me an email, kl@kerrylutz.com. Don't forget, make sure you sign up for your free newsletter on financialsurvivalnetwork.com so you don't miss any of this information. Michael, we're going to be talking to you again a lot and in the near future, I have a feeling.
Look forward to these conversations. Thank you, Kerry.